When you put money in the bank, most people think it's their money, safe, waiting to be withdrawn anytime. But legally, that's not exactly true. In reality, when you deposit money into a bank account, that money no longer belongs to you. It becomes the bank's asset, and you become what's called an unsecured creditor. That means if your bank ever gets into serious financial trouble, you might be one of the last in line to get paid back. And this is where something called bail-in laws come into play. Today, we'll break down what bail-ins are, how they were created after the 2008 financial crisis, and why they're controversial. Some say they protect taxpayers. Others say they put your savings at risk. After 2008, governments realized that bailouts, using taxpayer money to rescue failing banks, were politically unpopular and financially dangerous. So regulators created a different tool, the bail-in. Instead of governments rescuing banks with public funds, a bail-in lets a bank rescue itself by using its own resources and creditors. Here's how it works. If a bank is in danger of collapsing, regulators can force certain types of investors, and in some cases large depositors, to take a loss. Their money can be converted into shares or even written off entirely to stabilize the bank's balance sheet. In short, bail out, taxpayers save the bank. Bail in, the bank's creditors, potentially including you, save the bank. When you deposit money into a checking or savings account, you're lending that money to the bank. It's not stored in the vault with your name on it. The bank uses it to make loans and investments. In exchange, the bank promises to repay you on demand. Legally, that makes you an unsecured creditor, meaning, in the event of insolvency, you stand behind secured creditors, bondholders, and others who have specific collateral. In a bail-in, your deposits above the insured limit could be converted into bank shares to help recapitalize the institution. The most famous example happened in Cyprus in 2013. Two major banks were collapsing, and rather than a taxpayer bailout, depositors were bailed in. Those with balances above 100,000 euros saw portions of their deposits converted into equity, effectively losing part of their cash to save the bank. This shocked the world. It showed that under the new post-crisis rules, depositors themselves could bear the cost of a bank failure. Since then, most major economies, including the EU, UK, Canada, Australia, and even the US, have adopted bail-in frameworks. Bail-ins were created to prevent too-big-to-fail institutions from collapsing in a chaotic way, and to stop governments from spending billions of taxpayer dollars to rescue private banks. The idea is that banks and investors, not taxpayers, should bear the risk of banking failure. In theory, that's fair, but critics argue it exposes ordinary depositors, especially those unaware of how the system works, to unexpected losses. So what can you do? Stay below your country's deposit insurance limits. Diversify your holdings across multiple banks or asset classes. Keep informed about your bank's stability ratings. Bail-ins aren't about banks stealing money. They're about a legal process designed to stabilize the system during crisis. But if you don't know the rules, the surprise could feel exactly like theft. Understanding how bail-ins work gives you power. The power to protect your savings and make smarter financial choices. I'm Ed Anderson, the host moderator and all-around nice guy of the Hey Ed YouTube channel. Please like, subscribe, and ring that notification bell.